Thank you very much, and good morning, everyone. Welcome to this presentation of EQT Holdings half-year results to 31 December 2018. I'm here this morning with Philip Gentry, our Chief Financial Officer and Chief Operating Officer. And what we're going to go through today is just talk to you about the results for the half-year, in particular go through all the financials. I will then come back and talk about the strategy update and the outlook for the company, and then we can take questions at the end of the presentation. So let me just firstly give you an overview of the results. It's been a very strong half year, and I'll compare here the results to the prior corresponding period in the 2017 year. So net profit after tax attributable to shareholders was up 17.3% to $11.2 million. That is primarily driven by revenue, so our revenues were up 7.2%. So it's continuing the trend that we've seen in the recent halves, up 7.2% to $46.3 million. We have continued to invest in the business, but we have had disciplined expense management, so expenses were only up 3%, so a very positive gap between revenue growth and expense growth. Pre-tax operating cash flow is up 28.6%, so you can see these results are flowing through in cash flow terms to the business. Our funds under management, administration and supervision were down slightly by 4.3% to $77 billion. That's reflecting the weaker markets. Bear in mind we're reporting here funds under management at the end points of the time periods. Our basic earnings per share was up 16.1% to 55.13 cents. The board chose to increase the dividend for the half year, so the interim dividend has been increased by 4 cents to 44 cents per share. So I'm saying 4 cents on the previous interim dividend and 2 cents on the dividend of the last half, so to 44 cents per share. Our balance sheet remains in really strong position, and Philip will take you through that. We've taken the opportunity to reduce debt slightly through the course of the year by 20%. And importantly, we are delivering for all stakeholders. So the focus of this company is on delivering for our clients, delivering for our staff, our shareholders, and also the community, and that has been a strong focus through the half year. We are investing in opportunities for growth. Our Equity Trustees Independent Specialist Trustee strategy is really aligned with the findings that have been coming out of the Royal Commission. We're seeing more inquiries for our services than we've seen before. The industry environment is very favourable to looking at the specialist trustee model. The model that we put to market is a better model for managing conflicts. That was a very significant focus of the Royal Commission, and also the utilisation of specialist services where it makes sense. And there's no doubt we're seeing an increasing pipeline for new business opportunities, and that's both in the superannuation side of the business, but also in our provision of responsible entity services. Of course, looking at these larger scale opportunities takes a lot of time and effort, so we are investing in the people. We're investing in the processes, and we're investing in technology to make sure that we can support this growth. I think the important aspect about this set of results is we're getting good performance out of all parts of the business, out of Trustee Wealth Services and also out of Corporate Trustee Services. And the acquisitions and partnerships that we've talked about in the past have all been performing as planned. So the small business that we acquired in the UK and also operating out of Ireland, which we've now called Equity Trustees UK and Europe, it was formerly Treasury Capital Limited, has been starting to get market traction, and particularly getting market traction in a way we expected with some of the larger scale funds managers in those markets. And the final point, the Aon Master Trust, where we took on the appointment as a superannuation trustee back in November 2017, has been performing well. We did a major successive fund transfer in that business through the course of the period, which has gone very well. And the business we acquired, the responsible entity business from OneVue, is also been performing as planned. Now, if I just look at this slide here, it just shows you the impact of movement in the funds under supervision on the left-hand side for Corporate Trustee Services and the right-hand side for Trustee Wealth Services. And you can see our funds under supervision has decreased slightly, and that's a function of the markets. Bearing in mind these are endpoints for funds. And also there's been a significant amount of movement of funds flow of various corporate trustee services clients through the period. Some of that positive, some of it negative, and I'll talk more about it as we get to the detail of corporate trustee services. And trustee wealth services on the right, you can see the funds under management has decreased from 15 billion to 14.2 as an ending point. Obviously, trustee wealth services is not immune to market movements, but bear in mind the ASX 200, which is the prime asset class running through trustee wealth services, was down somewhere of the order of 8% between these 2 points. So, we've continued to put on positive funds despite the market movements. If I now just look at trustee wealth services and the highlights there, I'll start on the left-hand side, now core trustee services, so estate management, testamentary trusts and perpetual charitable trusts. You can see that estate management is up considerably. Now this can be lumpy. We obviously can't predict the number of, the particular accounts that come through into estate management at any point in time, and it is quite lumpy, and this reflects one or two very big estates that we're currently working through at the moment, that major increase. Testamentary trust is down slightly, and that reflects the fact that we had one particular testamentary trust of the order of 30 million that vested through the time period, and on that vesting all the funds were directed straight into a not-for-profit charity. We have written 29 testamentary trusts through the course of the year, so that will, over time, will obviously offset that loss. And perpetual charitable trusts, that decrease there, it just reflects market movements. We wrote 5 new perpetual charitable trusts through the course of the time period, so happy with that. Now, if we look in the middle block there, you've got the new trustee services where we're increasingly putting our focus. Indigenous trusts, a really nice increase of 23% there, and we're feeling very positive about how we're presenting ourselves to the market, particularly over in Western Australia in that area, and we see good opportunities going forward. In the living donor space, this is an area we've been focusing on. We've invested with new people in that area, running our business development activities in Melbourne and Sydney, and we're starting to see some of that come through, which is great. And the compensatory trusts, through the course of the year, we've had a little change there as to the partners that we've been working with in that area, but of late we've written 8 new compensatory trusts, which is a 6% increase on the prior corresponding period, and I'm feeling really confident about how we're positioned in the compensatory trust market. Then finally, over on the right-hand side, you've got the superannuation area, and you can see the increased scale that we now have as a result of the appointment to the Aon Master Trust. We wrote 1 new fund through the course of the 6 months, and that was Crescent Wealth, and that increased the funds under supervision. But of course, the total funds have decreased slightly as a result of market movements. If I move on to the highlights for corporate trustee services, now on the left-hand side there you can see the number of clients or funds managers and the movement of those numbers through the course of the year. We've gone through the course from the prior corresponding period. We have increased the number of fund manager clients that we have in corporate trustee services by 14.9%. So you can see we've brought on 35 new clients, and the managers that have exited have been 8. We had one particular manager we provided compliance services to, and a range of the managers that they had underneath them. And we did that on a basis we always thought would be a temporary basis until they had their resourcing and arrangements organised appropriately, and they've got that now, so they have taken that service back in-house. But you can see even with those movements that we've gone from 114 clients to 131 between the 2 periods, so it really is a really solid underlying growth rate. On the right-hand side, we've talked before the fact that we are increasingly trying to build our presence in the debt, capital and loan markets, and we've got 3 people on board in that area, 2 in Sydney and 1 here in Melbourne. And you can see the increase in the number of deals that we have completed in that area. Now, this is off a very small base, but it's, I think, very encouraging that we're starting to see success in quite a number of different areas of the debt capital and loan markets. So in the prior corresponding period, we'd written 2 new deals. In this most recent period, we wrote 19 new deals. On the right-hand side, you can see where some of these clients are coming from, and I think the positive aspect that you can see there is that they're coming from all locations. So we've had a number out of Australia, some names there that you will know. In the United Kingdom, we picked up Adavora, so that was a client that we picked up here in Australia first, and then picked them up in the United Kingdom. So that's really focusing on, if you like, the strategy of leveraging our client base here in Australia to build our UK and Irish business. And we always are picking up clients out of the US, and a great name in Heitman and Western Asset Management, both, absolutely first-class managers in their respective asset classes. If I move on to the next page, you've seen this before, that our focus is on delivering to all stakeholders, and we feel we have a real clarity of purpose with these T4 targets. And, the discussions in the market of late have really, focused people's attention on whether there is enough attention being put on clients at the expense of shareholders. But for us, that's the number one target that we have, is satisfaction for our clients and improving that. Secondly, we can't do that unless we have our employees engaged, and that has been an enormous focus over the last 2 to 3 years for this organisation, and we're achieving fantastic results there. And of course, growing our shareholder value. And finally, because of the special nature of this company, we can have an enormous impact on the community with our philanthropic activities. I'll look at each of these targets now. The targets that we've set for our clients is a Net Promoter Score and the Net Loyalty Score. We're about to go into the market and do surveying again of the clients and looking to see how we go. But we've put a lot of focus in how we are delivering to all of our clients and beneficiaries over the course of the last 6 months. So we're looking forward to updating you on how those results have changed. Likewise, we do annual surveys for staff on their engagement and their enablement to do their job, and we're just about to be surveying there again, looking forward to sharing those results with you when we have them. If I go on T3, earnings per share, you can see there the healthy increase from the final second half year FY18, 49.8 cents increasing to 55.13 cents, so more than a 10% increase. And you can see the consistency of earnings per share increase since the first half of 2017. So, we now have really, 5-6 periods of absolutely consistent, very material increase in earnings per share. On the right-hand side, we've updated the granting numbers. So this is philanthropic granting going to the charitable and not-for-profit sector. And you can see in the June 18 year, that number ended up being 87 million. That picks up 76 million of regular granting coming from our perpetual charitable trusts and from our foundation and from our living donors, plus another 11 million coming from one-off grants coming out of our estate management area. So, an enormous contribution to the community. So I'll stop there and I'll hand over to Philip, who will take you through the financials.
Thank you, Mick, and look, good morning everyone. Let me now take you through the financial performance of the company for the half in a little bit more detail. And firstly, starting with the profit or loss, you can see here a summary. Good revenue growth, up 7.2%. As Mick said, expenses contained to around 3%, giving a pretty healthy increase in net profit before tax. The increase in the effective tax rate was due primarily to some higher non-deductible items. And pleasingly, you can see there's a reasonable increase in the net profit before tax margin to 34.9%, and accordingly a strong increase in the both NPAT and dividend as a result of that performance. So let's now look at the half-on-half performance in a bit more detail. And again, here you can see the trends over the last 5, 6 or 7 halves, and pretty consistent since FY16, and very pleased with that trajectory. across all of those four metrics: revenue, net profit before tax, EPS, and dividends. Let's now have a look at the revenue growth composition. On this bridge, you can see the various drivers of revenue growth. And essentially, three components. On the left-hand side, you can see the impact of the acquisitions that we've made, the OneView RE acquisition and the UK acquisition. And you can also see the impact of the client exit in relation to compliance services that Mick talked about. There was also one other large client who continues to be a client, but had some large mandate losses. There was some positive equity market impact on FUMAS. This is largely more on the global MSCI than on the ASX 200, and I'll get to that shortly. And of course, some reasonable organic growth as well. And now turning to cash flow. Again, a very strong operating cash flow, up 28.6% on the PCP, largely driven by the increase in earnings and the increase in revenues and the increase in margins. So pretty consistent, high quality cash generation, and principally used to repay 4 million of debt, tax payments, and dividends. Turning now to TWS and CTS in a bit more detail. Firstly, TWS, an improved performance here, and again, some equity market assistance, although not by as much as we might have expected. Equity markets were obviously volatile, and while point to point they were down, the actual average was slightly up for this business, and that's reflected in the positive assistance you can see there. But obviously some reasonable organic growth as well. On the right-hand side, you can see the FUMAS chart for TWS, and of course, slightly down, reflecting those weaker equity markets. Now turning to our corporate trustee services business. Again, on the left-hand side, you can see the impact of the acquisitions, the impact of the client exit and loss of mandates of one client, the equity market impact, and the organic growth. So three drivers of the revenue, and again, a pretty good performance from CTS, revenue up nearly 18% on the PCP. And now turning from the businesses to the balance sheet. Balance sheet remains very strong, debt down 20% to 16 million. We have a very low debt to equity percentage, plenty of borrowing capacity and headroom in our covenants, and flexibility to take advantage of growth opportunities. The contingent liability remains in our financial statements in relation to our dispute with the ATO, and that is likely to go for some time. We've reached a point where we are going to seek rectification of a particular contract that the company has through the Supreme Court, and that could take 6 months or so. And the ATO has agreed to defer a final decision until the outcome of that particular proceeding. So you'll see that disclosed in more detail in Note 12 to the financial statements, and we'll keep you posted in that regard. Now turning to the capital position. We continue to have a strong capital position. There are some opportunities still to improve efficiencies in capital, and we're working through those. From a dividend policy standpoint, we're right in the midpoint of our 70 to 90% payout ratio at 80%, and we have plenty of capacity to provide further flexibility for selective investment or acquisitions. So in summary, we've had good, healthy revenue growth, disciplined expense management, a moderate margin improvement, and a healthy increase in NPAT and dividends. The strategic initiatives are delivering as planned. We have an encouraging pipeline of opportunities, together with the balance sheet capacity to support our growth plans. Let me now pass you back to Mick to provide a strategy update and outlook.
Thanks very much, Philip. So I'll just give you an update on our strategy and the outlook for the company. So to be clear, the strategy hasn't changed. We aim to be Australia's leading specialist trustee company. Increasingly, we would like to see that on a global basis, and we're doing that on the corporate side of our business. But being a specialist trustee is our complete focus, and it really is paying off, we think, in this environment. The industry dynamics are very favourable. We've spoken about these before. Our business is driven by the wealthier and ageing parts of the Australian population, and they are the fastest growing cohorts in the Australian population. It's also in the superannuation side and in corporate trustee services underpinned by the mandated flows into the superannuation system. So really strong industry dynamics behind each of our businesses. It has been boosted of late with the industry transformation that's going on. The various divestments that have been made by some of the more diversified financial services groups is opening up opportunities for us. And of course, the Royal Commission and the focus on trustee obligations and services and managing conflicts, which was a very significant part of the Commissioner's findings, has really been helpful to the business and very much aligns with the services of a specialist independent trustee that we're providing. The global opportunities are strong for us. The markets we're in, the UK and Ireland, are very significant markets, and just reminding people, the Irish market is a larger market than the Australian market, because it is a central place for funds managers to domicile their vehicles in, and we are starting to see some good success with high quality managers wanting to utilise our services in those locations. I think it's important just to stop and talk briefly about the Royal Commission and also our focus as an independent specialist trustee. So our focus is purely on being a trustee, and that is all about governance, it's about risk management, and it's about making our fiduciary responsibility the number one issue in our business. It's our core business. The industry changes that have been going on, particularly the divestments, have caused people to think, well, what's the best way to structure their arrangements, both from an investment perspective and also from a superannuation perspective. And that is throwing up plenty of opportunities for the business. And when we talk to clients, what we talk about is a best practice model of trusteeship, utilising specialist expertise and ensuring a structural independence within their sets of arrangements. And in many cases that avoids conflicts completely, or if it doesn't avoid them, it puts in place a position that is much better, much more easier to manage than what the current arrangements are for different players. And for those players, the real benefit for them is it allows them to focus on their core business. Trusteeship is probably not a core business of any of these financial services groups. They're either specialists in insurance or investments or administration or advice, whatever it may be. But we're specialists in trusteeship, and we take that risk away from them, we take that obligation away from them, and it creates efficiencies and synergies for them. So we're seeing increasing inquiries for our services, and the pipeline of new business is growing. They do take time to put into place. They're complicated, but well worthwhile in the end for us. Now, this next slide, I think, is one of the most important slides in the deck. Equity Trustees has a great balance sheet, as Philip has just told you. We have licences where we need them. We have a 130-year-old brand that really stands for trust. But it's people that make the difference in an organisation like this. And over the last 6 months, we have been very focused on getting the right people into the organisation and building our capabilities. And I'll just really quickly step through them. We made a new appointment to the EQT Holdings Limited board in December, Tim Hammond. Tim was previously the Chief Executive Officer at Mutual Trust and is going to bring an enormous amount of experience in our private client type business to the board. For Equity Trustees Superannuation Limited, our specialist subsidiary superannuation company, we appointed a new chairman, Tony Lally. Tony has more than 30 years' experience in superannuation, building the Sunsuper business, and previously to that at Colonial, and he is bringing incredible experience to that board. Just recently, we have appointed Sue Everingham as a non-executive director to that board just in the last week. Sue was previously leading the trustee business of Commonwealth Bank, looking after all of the Colonial superannuation entities. So we're delighted to have her on board. And also 2 weeks ago, our new Chief Risk Officer commenced with the organisation, Owen Brailsford. Owen was the Chief Risk Officer at Telstra Super and also has experience at the regulator, so we're delighted to have him on board. We've talked previously about asset management and us increasing the level of expertise we had. We brought on 2 really experienced senior leaders into asset management to head both the asset management function and Australian Equities, and that is really coming along very nicely for us. In corporate trustee services, we've been putting resources on in the UK and Ireland as we expand our global footprint. Trustee wealth services for the private client side, I mentioned before, 2 specialist people in philanthropy to try and build our business in the living donor space. We're bringing on 2 more specialists in the Indigenous Trust area to cope with the growth that we're experiencing there. And then finally in superannuation, just in the last couple of weeks, we've brought on a senior client manager to look after some larger scale funds that we expect to bring on. And this gentleman has incredible expertise in trusteeship, in superannuation, investments and insurance, and we're delighted to have him on board. And finally, we're expecting another person to come on shortly who has enormous regulator experience, which is an increasing focus for us. So we're delighted that all the people that we're targeting, we've been able to secure for the organisation. Just touch very briefly on developing our digital capability. It's a strong focus for us. Particularly, we've been focused on the CRM side in building our capabilities there to ensure we can look after the increasing client base. We're piloting robotic process automation in different areas, and that's proving to produce efficiencies for us. In the estate management and estate planning side, we're focusing on the client experience and ensuring increased productivity for staff by utilising technology. I've mentioned before that we are digitising our complete will bank, which will then enable us to interrogate that data and provide better service to clients. So it's a strong focus for us to focus on improving in technology. Now let me just step through each of the areas and comment on particularly where we're focusing at the moment. On the private client side, in estate planning, we are leveraging on our will bank and focusing on key strategic partnerships in the distribution. So, I've said before, we don't compete with our distribution partners, so we're here to provide the specialist service to private banks, to the high end of the financial planning community, to the legal fraternity, to the broking community, and our focus is on those strategic partnerships. In estate management, our focus is on improving the beneficiary experience, and that's designed to increase our cross-sell opportunities for those clients. Funds management, I talked about strengthening the team there, and we're rationalising our products there to enable that team to focus on delivering excellent investment performance. On the advice side, again, it's a focus on cross-selling to those advice clients, our high-value clients that enjoy a great relationship with Equity Trustees, and we can provide other services to them. In the philanthropy area, we are trying to leverage on our expertise in granting. We are one of the largest grantors of philanthropic grants in Australia, and it is a real specialty of a team of close on 20 people, and we're determined to make the best difference with the way we grant those funds. So it's not that easy to give away $80 million, and we want to ensure that every dollar goes into making a difference. We're in the next couple of weeks publishing our giving review, our first giving review, which really will showcase our scale and the capability of the philanthropy team. And finally, in trust management, our focus is on the specialist areas of Indigenous trusts and compensatory trusts, and also just generally improving our service delivery model across that business. I want to just spend a minute commenting on reconciliation. We developed our first reconciliation action plan about 18 months ago, so we've completed our first full year. That really is helping us make a difference in Aboriginal communities. We're currently servicing 7 communities across Australia, mainly over in the west. We retired from one of these trusts through the course of the period because the community themselves had built up the expertise and capability to take on their management of their own trust, and we'd assisted them in doing that, so we're delighted they've got to that point. We also won 2 new accounts in the Pilbara. That's important for us because it's the most significant area of Indigenous wealth, and we think the service that we can provide in those areas can see us win more accounts over time. And we're increasingly trying to focus our philanthropic granting in areas of Indigenous need, where we're now building up a greater experience and knowledge base. If I move on to superannuation, and this really is obviously a hotspot of the market, and our business model and our brand is really proving to be successful with superannuation providers where they don't see trustee services as their core. So there's really a strong appetite for this specialist independent fund governance capability. We're working on a pipeline of some material appointments. They take a long time, as I said, to put into place, and they're quite complicated. But we're definitely investing ahead of the curve in this area by putting on people and improving our digital platforms to support anticipated growth. We'll move on to corporate trustee services. We continue the strategy, here in Australia of providing core RE services. We're seeing an increasing trend of quality Australian equity funds managers who have been operating the institutional market shifting to the retail market, so that works in our favour. We're seeing an increasing appetite for listed investment trusts, which also works in our favour. Also, superannuation funds, as they build more sophisticated investment platforms and increase their scale, they're increasingly looking for trust solutions as well to underpin the superannuation funds. So we've got more superannuation funds coming on as clients than we've had in the past. We aim to be at the leading edge on the corporate collective investment vehicle regime for any Australian manager wanting to elect into that regime and market their products offshore in Asia. And we now have the OneVue responsible entity business fully integrated as we planned. Our focus at the moment in Australia is on larger scale opportunities as funds managers and promoters look for this specialist outsource model, and a lot of this is being driven by the various divestments that have been going on in the market, and that is a strong focus for us. We continue to extend into new markets here in Australia. I mentioned before our structured finance offerings, and we're seeing more opportunities on that front. And finally, if I just talk about Ireland, our expansion into Ireland was always part of the plan when we acquired the UK business. That business was passporting fund governance services into Ireland, but now we'd be looking to provide those services directly in Ireland. We're starting to see new large US and UK funds managers wanting to utilise our services, and I'll be looking forward to talking more about that when we can talk about particular wins. The Ireland expansion is well underway. We've got a licence application with Central Bank of Ireland in its final stages. We've opened an office in Dublin during this month. We have our initial staff already appointed, and the expansion is well advanced. And we're targeting a break even on the combined UK and Ireland business in the financial year 2020. The breadth of services that we offer means that we're well placed for any Brexit outcome in either location. So, in summary, it's been a really strong half year. We've seen a substantial lift in financial performance in net profit after tax, in revenue, earnings per share and dividend are all higher. The operating cash flow is really strong. These results have been built on fundamentals and sticking to our core strategy. Our margins have increased despite the volatile markets. Each of the acquisitions and partnerships we've entered into have been delivering as planned. We have been investing, but we've got a disciplined expense management approach that has kept that expense growth well managed. And it's clear that our specialist independent trustee model aligns with the Royal Commission's findings, and we're delivering for all stakeholders. So I think we're well positioned for growth in the remaining half of the year. We have got good momentum. The workforce is committed and engaged, and we're securing the staff that we need to carry on the functions that we've got. The industry fundamentals for us, both in Australia and overseas, are really attractive. We're leveraging on our core strengths and capabilities, and we're focusing on our single strategy. We're investing in the people and technology. We will continue to do that, and we will do that ahead of the curve. The pipeline of opportunities is growing, and we think it's an encouraging outlook for the remainder of the FY19 year and beyond. So I'll stop there and happy to take any questions. Yeah. Mm-hmm. All right. We've got one question here, which relates to, we've talked about the pipeline of opportunities in the past, but can we comment on just how quickly some of these will come through? Okay. Well, look, each large-scale opportunity is unique and takes time to put in place. And bear in mind, when these things are put in place, they're put in place for a long period of time. So a lot of things need to be set up at the foundation. But the reality is our discussions with different parties are quite advanced. Often arrangements are linked into broader timing arrangements for organisations, and we've got to work within those. But we'd expect, some good prospects through the second half of FY19 to come to light, and obviously we'll tell the market about those as they arise. Just look for any other questions. Questions come up here about Brexit and whether the uncertainty being driven by the ultimate Brexit solution, the timing of that is causing an issue for our businesses in the UK and Ireland. Look, the answer to that is it's not easy to work with the uncertainty, but we are going to have a business that is set up to provide domicile vehicles both within the UK and within Europe through Ireland. So our business will be set up to handle both locations equally well, so we're not overly concerned which way Brexit is going to go.
Next, there's a couple of other questions here. The first one is, can you provide any commentary on the levels of inbound inquiry today vis-a-vis our historic understanding of those?
Okay, all right. I mentioned before that the inquiries are coming to us in respect of superannuation trustee appointments and also in respect of responsible entity appointments. We've always had a very high level of inquiry in our responsible entity business because we're the leader in the Australian market in that area, and really there hasn't any type of fund construction that is available to put into place in Australia we've been able to put in place. So, I think what's notable on the responsible entity side is the inquiries that are coming in are for larger scale opportunities. Most of our client base, we've been with them from the start and we've built them up with our clients from nothing. These opportunities are arrangements that are already in place and looking to transfer responsible entityship. On the superannuation side, well, the number of opportunities has increased and the inquiries have increased, and that's really just a function of, I guess, the regulator is much more active in encouraging some of the smaller funds to look at different ways of structuring themselves, and also existing superannuation trustees have been reconsidering what they should be doing given the intense focus that the role has undergone in the Royal Commission. So, there is an increase in the number there.
There's a follow-on question here, Mick. Do any new potential clients require further investment in staff and systems?
Absolutely, they do. So, whilst we've talked a lot about technology, this is a people business. We need specialists and experts to carry on these functions. And whilst we've got them within our ranks, as the number of funds and the number of clients increases, and sometimes the complexity of some of those funds may be increased to what we've been dealing with, we need to bring the people on board to do that. And mention on that page a number of the key people that we've been bringing on, so we're definitely investing ahead of the curve to get those people on.
Thanks, Mick. And then another question, is the UK-Ireland break-even and FY20 guide based on current run rates or are new client wins needed? And happy to talk to this one. Essentially, we'll be able to talk a little bit more about some of the more recent wins in the next few months, which will give you some sense of the momentum building in that business. And they're a function of a couple of things. One is the number of new clients that we put on, but also the level of FUM that is attracted to those funds. And our view is that if the current trajectory continues, then the break-even in FY20 should be more than achievable.
Okay, I'm not sure there's any further questions, so we might call an end to it there, and we'll be out talking to shareholders and investors over the course of the week, and looking forward to doing that. So thank you very much.